So I'm going to show you this here. This is Tuesday, December 23rd, 2025. 1 minute candlestick at 9:54 a.m. Now, why am I picking that one? Well, what you're looking at is a pair block run right out from Jump Street. So at 9:30 in the morning, they just ran it straight from there. Created a short-term high, rallied above it, false break above that, and turtle souped it right back down into the initial run. That shift right there below the swing low in here, that displacement is significant. Go back over your NASDAQ chart and you'll see that this short-term run here stands out on your chart. So when I'm looking at price action where price has been made jagged, like it does here, I don't need it to take out that low. I just need it to show me these types of fair value gaps. So when they stand out in price action where price has had a turtle soup, a major displacement, or it just leaps out at the chart. Zooming out, not zooming in tighter, okay? By zooming out, your eye will jump right to these types of swing highs and swing lows. And when these runs are occurring, there's lots of manipulation in that. And you're going to be best served by going in and looking for these types of imbalances when they first form. Notice there's no fair value gap here until that, after it took that high. So this PD array is first presented fair value gap after turtle soup. Now this can be done on the buy side. This is a sell side. So what we're looking for are standouts for fair value gaps. The comments that come up a lot are, why did I pick that fair value gap in that respective video they were commenting on? I want you to think about how what I just said about here. When you have a turtle soup sell-off, buy side taken, and it starts to sell off, you don't need this to be a market reversal. You just need it to show these types of characteristics. The first fair value gap that forms after that, keep that on your chart. Project that forward. Think about the up-to-data ranges. What's the lowest one? 20 days. Keep it on your chart for 20 days. That's why this is still valuable to me. Now, by projecting that forward in the future, I'm already ahead of the curve. And I knew this level is going to be important well before your volume profile is populated on your chart. In the future, right here, I already know this is going to be a viable level in the future. Now I just simply have to wait for time to agree and meet with that price. What does that look like? Well, that's the high of that run. That's the market reaction there. Now, right away, you should know the opposite of that. It was a nice little rally all the way up in here, and overnight, here's your lows. So cast forth a vision. If it's running quickly up to that level and it proves to you it doesn't want to stay there, it starts to sell off. And then we're entering the time of day when we're looking for the opening range, 9:30 in the morning Eastern time to 10 o'clock. We're looking for that first presented fair value gap. That's that right there. Now, right away, you can see it's using it here and here. And where do you think it's drawing to? Before this even formed, before 9:30 even happened, while it's dropping down, in your mind, you're going to cast forth a vision. This is what I do. I'm looking at the market and I'm casting forth a vision. I'm waiting for a price run that creates a long, protracted down close candle. I'm waiting for that to form. I'm anticipating that to form. Because I know all of this reaction from this run here is likely to see us go all the way back down to take overnight lows. That's the draw. Now, the easiest way for you to have this on your chart or a routine is overnight lows. Just simply mark off midnight Eastern time to 7 o'clock in the morning. Whatever the lowest low there is, if it's relative equal lows, that's a loaded deal. That's where liquidity is. It's going to want to seek that if it's bearish. Not all the time, not that very day, but that's how I classify it. I'm looking for that lowest low overnight. In this case, we can see it being here. So that's a relative equal low. So you can see that that's obviously a standout. That's your sell side liquidity. We have the displacement here. So that's the first presented fair value gap after 9:30. And the market uses it here and here. And then we start getting into this back and forth type price action. This is classic of the holiday season. But in here, we're going to take a look at this. We're going to zoom in and deal a little bit more with this. But I want you to think about that level right there being these lows. That's the draw. So I'm casting forth a vision on how price would traverse from this first presented fair value gap down to that low. When the majority of the run was accelerated, so half that run was real quick and sudden. And now it's a lot of give and take back and forth, reaching down into that sell side liquidity pool overnight. So we're going to focus in on that little area right there, and we're zooming in. Sell side imbalance, buy side inefficiency. The market creates the fair value gap when this candle closes. It trades up into it here, and we're anticipating price reaching lower. The market drops down, comes right back up, trades to the low of the fair value gap. That's the first presented fair value gap. We do not abandon the idea it's reaching for overnight lows. You cast that vision forward. On the chart, you're expecting it's going to deliver. Until you're proven wrong and it's obvious, you keep that vision in mind, how it's reaching towards that relative equal low overnight. Every single candlestick has its place. It has its role in the plot. But not every single candlestick is a supporting actor. And it's not a leading man or a leading woman in the plot. So the market creates this run up and then starts to slowly work lower, then gyrates sideways, moves a little bit lower, gyrates sideways, and starts looking like a very frustrating type of profile. It's simply how price is being held in consolidation. So when I see price doing this, I'm going to look for leading men or leading women candlesticks in the plot. The plot is this booger is going down to take those overnight lows out. Now, every one of these candlesticks in here is just like, just an extra in the cast. They're not even getting paid to be there. They're just happy to be a part of it. And that's what's being shown here with all these different kind of candlesticks. But what I'm looking for is I'm looking for the candlesticks that have the time in the plot to start pulling forth their best acting. They're going to bring out an Oscar-winning performance. Well, we're going to bring in time now. 9:50 to 10:10 macro. The market creates this return back into the first presented fair value gap. We anticipate this acting as a premium array. It should repel price or keep it from going in the upper half here. It just comes up, just breezes to the low of it, and then says, no, I'm not interested. No thanks. And then what does it create here? What's that? That's a SIBI. So now that is a leading man or a leading woman candlestick. It's going to be impactful. So now we want a supporting actor or candle to come up and show how great of a candlestick this is by it coming up to half of its range. You see that? So here we have the consequent encroachment of the SIBI, and then we start to see the price diving lower again. But now, look closely. We're zoomed in. We have a little bit more data on the price action, and we have two relative equal lows. What makes them relative equal? The one to the right is slightly higher than the one to the left. So this is a strong candidate for a raid on that sell side algorithmically. That's how your eye is supposed to identify it, okay? It's less likely to see that immediate run. Like, for instance, say we were looking at this low and that low. This is not a relative equal low. It's not a high probability. It can eventually trade through it, but not without at least retracing back for an inefficiency above the low. In other words, something going back to the left, either an inefficiency or a short-term high. That's why I'm teaching you and have taught you for years to look for the low to have the slightly higher low to the right. If it looks like this, chances are it's going to have a deeper retracement. It wants an efficiency premium, or it wants a buy-side liquidity pull. Price runs up into these highs and fails to even get back to this old fair value gap. So it's just consolidating. Now there's a paradigm shift that takes place. Everything is available in these open, high, low, and close candlesticks. Everything's there. But what you're waiting for is the time for them to perform. But you have to know the plot. The plot is it's running for sell side. And the sell side is determined by overnight lows. So those lows are like that big magnet. And you're casting forth a vision that you're looking for this plot to pan out with Oscar-winning performances by very specific candlesticks at very specific times in the storytelling. During the macro, trades up to the low of the fair value gap. That's first presented fair value gap. Price trades up to consequent encouragement during the same macro. It trades lower. No fair value gap in here except for this little tiny piece right there, which is like nothing. It's like an extra in the cast. Why is this not so important? Because we haven't even broken this low. So that right there is not important to me. If this would have broken down below that, then that would have been much more salient to the plot. But because it hasn't even taken that low out, that fair value gap is just a common gap. Why don't you use this fair value gap, ICT? See how it's starting to make sense now? So we had the run on minor sell side liquidity there, and then we retrace back up into the range. Range. What's the range? See that price action right there? From the premium array it reacted to the new sell side low that was taken right here, that created that low and then started retracing. That is how you're defining your range. Let me say it again. The PD array that it sold off from, my content, my concept, that turning point, because that's not support and resistance. What is that? It's the first presented fair value gap that formed after 9:30. And it's in the direction that the plot is. Sell side is going to be the target. It's going to be the draw. So we want to see this used like it does it here. Sell off. And because it can't even get into the upper portion or even trade back to the consequent encouragement of that first presented fair value gap, it's exceedingly weak. So all this in here is making it harder for someone that doesn't understand that. So the range is this right there. Now, think for a moment. When I'm looking at this range here, it's defined simply by time and my PD arrays. There's no overlap here with volume profile. Look at the midpoint. See that right there? There's a lot of price action being offered in that same range. That equilibrium price point has to have an inefficiency. Inside that range, we can see, there you go. What's that? That's a SIBI. If I take that SIBI and extend it through, look at the magic that happens. So by having this, I'm going to take that little range box off. We can anticipate how far that shallow run below that minor sell side is going to trade right back up. And the bodies are saying, yeah, the story is still the same. All this was a plot twist. And it's causing people that don't know what they're doing to think that it's made a short-term low and it's going to rally up. But it's only going to go up to where I say it's going to go with this fair value gap. That's the equilibrium inside of this range during time distortion. We enter another time period where price reaches up into that old SIBI. And because I'm not trading supply and demand, I'm cutting through candles. I'm going back to that one. Why did I choose that one? Because it's in the middle of the equilibrium of that range, high and low, defined by liquidity and my PD arrays. These types of things repeat over and over and over again. They may be slightly different. They may have a little bit of a character twist over here and there, but generally they're doing the same thing. They're running for inefficiency. They're running for stops. That's it. Or they're waiting during time distortion. That's what you're seeing right here. New minor sell side liquidity. After reaching up into that, it sells off. Now, The bodies come up to the high of that fair value gap there, and then we leave it and then look at the bodies. They stay right at the lower quadrant of it. It's not highlighted, but you can do this on your own chart. The wick goes almost to the top, but the bodies stay in the lower half. That's the signature that you know it's getting ready to start falling. The minor sell side is taken here, and I want you to take a look how price resumed in again here, but moved over so you can see the ending run. This dive down in here, this last little piece of the run that takes us down into that overnight low. We had this small little gap after leaving this one. It comes up, trades into it. The bodies don't even come to the high of it. The wicks respect it. We drop down, consequent encroachment on that wick, and then we start to move lower. And we're going sideways, sideways, sideways until we get to a macro time. At 10:50 to 11:10, it's going to displace. Where's it going to displace? First run is here, so you cast forth a vision. Time for the market to run. Where? Lower. What's the nearby sell side? There. Where's it been drawing to, and where's the original vision that you cast forth over the chart? Overnight lows. It dives down. You have long, stretched out black limousines running down to the 654 club below that low. When you see price action through this lens of creating a narrative, a plot, why it should do this, why it shouldn't do that, what candles are standing out? They're leading men or leading women candlesticks in the storyline. They're going to have a major role. And the candles that use them later on, like this over here, these are supporting actors. The supporting actor is saying, yes, this person is falling apart. And we're going to show that she's falling apart because we can't overtake the high of that. And we're stopping right in the middle with the bodies. And then we have more supporting actors over here with these candlesticks, only going up to half of it. So the plot's not changed. This here is the same thing that is. We're in a range, consolidation. This old SIBI is a reclaimed fair value gap. It's being utilized here, but notice it only starts to displace lower when we enter the macro time. We run lower to take that low, and then we take that original overnight sell side out there. But wait, there's more. If we look at the overall run now, all this price action in here, what I'm outlining here is that skill set, how you adopt it, how do you learn how to do it like I do it. You have to create these little storylines in old price runs. And by understanding the primary factors of what makes my smart money concepts what they are, that logic behind them, one piece of the puzzle at a time. You cannot learn this quick. 5-minute trainer mentors out there, it isn't going to do it for you. That's not going to help you because you have to have all the supporting logic around why it's beneficial to even know it. The value in learning how to do this on your own as backtesting, which will transfer into future prognostication, because you'll learn to cast forth a vision on what is permissible for price. If it really is going to go down there and take that sell side out, what is reasonable for price to do this or not that? What limitations would you place on it if you controlled price? This is all part of narrative. Narrative trumps market structure. It's simply knowing what you're doing, knowing what not to do, when not to expect something, when to expect it. And it's all a derivative of time first. Time, then price. Time, then price. But it's always drawing to one of two things: sell side or buy side liquidity, or it's running for a premium inefficiency above price or inefficiency below price. That's the only things that can happen, folks, unless a geopolitical event comes out and the market takes off, and then there it is. So let's look at the afternoon. Now, I teach don't trade between 11:30 in the morning to 1:30 in the afternoon if you're brand new, because you're going to get chopped up. That lunch macro is sneaky. And if you don't know what you're doing, it can hurt you. So the way you avoid it is simply don't do anything. Wait till 1:30 in the afternoon, Eastern time, come back to your charts and watch how price sets up the PM session. Well, wouldn't you know it, market rallies up, approaches what, first percent of fair value gap again. Right in here, you can see we have minor sell side. It's high probability, relative equal lows. Why? Because the lows to the right of that one are slightly higher. We have an old low of the day formed at AM session. So you have AM session lows during regular trading hours. So that's regular trading hours, AM session low, sell side. The market sells off from here. Where should it sell off to? Sell side here. And then you want to see speed. If it can get below these lows, if it can speed up and start having elongated candlesticks to the downside, then you know it's likely to do what? Reach for that sell side there. So these lows here are perfect partials, perfect candidates to take a partial if you're shorting up here. This is an inversion fair value gap because it's the last major displacement on the upside before it hits a premium array and then it folds over. That right there is your model 2022, just on a very small time frame. And it's the first fair value gap after the rotation over. That right there. So the market drops aggressively after taking that low out and then clears the AM session regular trading hours low and just dives lower. Moving forward and offering the remainder of the day, you can see inversion fair value gap, uses the consequent encroachment there, sells off, fair value gap there, use that, sell it off, consolidation. John Murphy would love to see this highlighted on social media. It's a perfect bearish pennant. They occur sometimes, sometimes they're there. Breaks lower and then just fizzles out into the low going into the close of the day. Now, why did this run up here like that and then sell off? What makes that happen? And if you're looking at just simply 1 minute charts or 5 minute charts or 15-minute charts or 1 hour charts, you're not going to get what you need. You have to have a proper top-down analysis, and you have to at least consider the daily chart. If you aren't at least conferring with the daily chart in your trading, you are trading blind. So how will we use that information? What are we looking for? Oh, here's the daily chart. And I just recently, in 2025, released another PD array. It's the suspension block. It's an inefficiency. Now, normally, folks would look at this candlestick's low to that candlestick's high and say that's an inefficiency. Well, yes, there's an inefficiency there, yes. But the real inefficiency is framed by the volume imbalance down here and that volume imbalance there. So this candlestick's open and that candlestick's close. That's what's being shown here. So this candle's what's being highlighted. It's the ICT suspension block. It's another form of buy-side imbalance, sell-side efficiency. It is not, underscore, not a quote-unquote liquidity void. Okay? A liquidity void is when there's no trading at all. That's an actual gap. There's no buying and selling in there. That's a liquidity void. There's been no liquidity offered at all. That's the only void that exists in price. So there's your suspension block, okay? Now, by having this information on your chart, let's go back down into that same chart. Wow. What you're saying, ICT, is the market went down, couldn't even get to the upper quadrant of it, and consolidated. And then it retraced right back up towards the first percent fair value gap, and it's the high of that suspension block on the daily chart. That's a premium array. What do you think a premium array on a daily chart is going to do to price if it's bearish? Send it lower. Do you think it went lower off of that? Sure it did. But a lot of you probably were caught off guard because you're not looking for things on the daily chart. Cast forth a vision. Where's price at now? What is it permissible? Is it allowed to go to this high, to this inefficiency? Is it working in the upper half of a inefficiency above price while still being bearish? Is it respecting only the lower half of that? That's indicating bearishness. It's weak. It's going to send price lower. All these factors have to be weighed in the balance while you're doing it. Notice what it's done here at 130. It creates that little run up to the top of that daily suspension block. That right there is this high of that candlestick's open. So that little segment inside that candlestick is price simply going right here, going up to go down. That's all it is. And when you anticipate when price is going to likely do these types of things and gravitate towards, well, let's go back out to the daily chart. Half of this range here, that's this blue line here. So up here, upper quadrant, that's reasonable because it would be going below that low. If there's sell side below that, try to reach to the upper quadrant of that daily suspension block. It hits it, and look what it does. It hits it and slices through it. So it means what? It's likely going to reach for half of that range that's down here. And it just fell short of it there. We have the new week opening gap presently today formed there. But that's a nice drop off. That right in here. But it proves the point. Just getting out there and looking for something that makes sense. Is there a narrative that you can exploit behind what price is doing at the moment? If you can't build a narrative as why price is doing what you think it should do to find a price run to profit off of, if you can't make that make sense in price action, chances are you're forcing a setup, you're gambling, and you're going to go on tilt. That means you're simply bored or you're being impatient and you're not following a model. You're gambling. If there isn't a plug and play approach to what I see in price action, I've been here before. I know what it's doing. I know what it's trying to do here. I know it's going to use this type of manipulation. I know it's going to try to do this or that. That's how I can read every candle. And when I can't read every candle, I take a step back and say, I'm not interested. It's simple. I use the pre-market hours. That's being 7 o'clock to 9:30 in the morning. I'll watch during those times. And if I'm really dialed in and I'm calling every candlestick's fluctuation and I'm really in rhythm with it, I know I'm going to destroy the opening range. And I'm going to probably get the low of the day or the high of the day and just rip the market apart. But if I'm not able to do that in pre-market hours, then I'm going to wait probably till 10 o'clock. So I'll let the first 30 minutes trade. See how beneficial that is knowing that? Now, if you're not someone that considers the marketplace before 9:30 and you're not considering what the market's done between 7 o'clock in the morning Eastern time to 9:30 open, that's a plethora of opportunities in and of itself there. But for setting the tone for what the market should and shouldn't do, how it should behave, how it should deliver after 9:30 opening bell, there's no better resource than determining what the pre-market's done. In this case, this market ran up straight up during pre-market session just to get to an old December 23rd displacement fair value gap after a turtle soup. So those things matter. That's sometimes the answer to your question. Why did I pick that fair value gap? Chances are it was probably one of these. The concept of first presentation is important. It's very important. And if you understand what you're looking for, there's logic behind it.